SoFi Technologies, ticker SOFI, is currently trading live at 28.82, showing a gain of about 1.5% for the day. This price action is part of a very volatile intraday session. The stock opened at 27.00, saw a sharp dip down to 26.53, and then mounted a strong rally to hit a high of 29.07, and is now consolidating in the high $28 range. This is a stock with a massive 52-week range, stretching from a low of 8.62 to a high of 32.73, which tells you almost everything you need to know about the intense debate surrounding this company. The common belief is that SoFi, now fully armed with its national bank charter, is on an unstoppable path to disrupt the entire legacy banking industry. The public narrative is all about explosive member growth, relentless cross-selling, and its destiny as the Amazon of finance for the next generation. But the data under the hood and the price action we're seeing reveals a much more complicated battle. This isn't just a simple growth story anymore. The real fight is about credit quality, net interest margin compression, and the heavy burden of regulatory scrutiny that comes with being a real bank. That P/E ratio you see, sitting near 53, is not the valuation of a bank. It's the valuation of a high-growth technology company. SoFi is being forced to prove it can be both at the same time, and that's where the fundamental tension is gripping this stock. Today's trading is a perfect microcosm of this tension. The volume patterns are telling. On big up days, you often see a surge in retail-driven volume as the long-term holder community gets energized. On down days, you can sometimes see lower, more methodical selling, which might suggest institutional profit-taking or the initiation of new short positions. What we've witnessed today, with the stock rebounding so hard off that 26.53 low, indicates that the dip buyers are still extremely active. There is a clear line of support being defended around that $27 level. The battleground for the rest of this week, and likely the rest of the month, will be whether SoFi can successfully reclaim that 29.07 high and begin to build a new support level above $29, or if this is just another volatile midday spike that will fade into the closing bell. Given the previous close was 28.39, the stock is holding on to its gains, but the intraday whiplash shows the debate is far from settled. This volatility isn't just a product of retail sentiment and macroeconomic headlines. SoFi is and has been for a long time a significant target for short sellers. The expectation from the long-term holders, who you'll see discussing the stock actively on platforms like X and Reddit, is that any short position is just noise or manipulation from big funds who simply don't understand the long-term vision. The reality, however, is that the short thesis here is quite specific, well-articulated, and should not be dismissed out of hand, even if you are a committed bull. The argument from the short side is straightforward and hinges on two main points: valuation and credit risk. Short sellers look at that P/E of 53 and compare it to a traditional profitable bank like JP Morgan, which trades at a P/E of around 11 or 12. They see a massive, unjustifiable disconnect. They are betting that SoFi's tech multiple will collapse as it is forced to behave more and more like a traditional, slower-growing, and more heavily regulated bank. The second, and perhaps more potent argument, is credit risk. SoFi's main profit engine is its personal loan business. These are unsecured loans. Short sellers are betting that in a tougher economic environment, with persistent inflation and rising unemployment, the default rates on that unsecured loan book will mount far faster and higher than analysts are currently modeling. They see the recent gap profitability as fragile, arguing it could be instantly erased by a spike in provision for credit losses, the money SoFi has to set aside to cover expected bad loans. So, what can you do as an investor? This isn't just about picking a side based on feeling. You have to look at the data. You can track the official short interest data, which is typically updated twice a month. This tells you the exact percentage of the company's float that is sold short. For SoFi, this number is frequently elevated, often in the high teens or even exceeding 20% at times. A high short interest confirms that many are betting against it, but it also provides the fuel for a potential short squeeze if unexpected good news hits. Even more of a real-time indicator is the borrow cost rate. This is the interest fee that short sellers must pay to borrow the shares they need to sell short. When this rate spikes, it means the demand to short the stock is overwhelming the supply of lendable shares. This can be a signal that shorts are piling in, but it can also be a precursor to a squeeze as it becomes prohibitively expensive to maintain that short position. You can find this data on many advanced financial data platforms. It's also worth noting why large institutions short a stock. It's not always a simple directional bet that the company will fail. Often it's part of a pair trade. A hedge fund might go long a basket of traditional banks and short SoFi as a hedge, betting that the traditional banks will outperform the fintech sector. Understanding these more complex motives is important. It's not always the simple us versus them battle that gets painted on social media. What's your read on the heavy short interest in SoFi? Do you think it's smart money identifying real credit risk, or is it just a crowded trade waiting to get squeezed? Let me know your take in the comments. When you see a high-profile short report published, the first step is not to panic. Read their thesis. Do they have a valid point about the loan book? Are their assumptions about default rates reasonable? Then read the company's rebuttal and the bull case counterarguments. The responsible reaction is to use that information to reevaluate your own position, not to buy or sell based on fear. For those who might be newer to the SoFi story, it's critical to understand the business model and why it's so different. The company began its life in 2011 with a very specific focus: refinancing student loans for high-earning graduates from top-tier universities. This was their initial wedge. The strategy was to capture a high-quality, low-risk customer base very early in their professional careers when they were likely to have high future earning potential. From that single product, they expanded into what CEO Anthony Noto calls the financial services flywheel. The concept is to get a customer in the door with one product, perhaps a student loan refi, or more recently, a SoFi checking and savings account offering a high annual percentage yield. Once you are in that ecosystem as a member, the goal is to cross-sell you every other financial product you might ever need. Need a personal loan for a home renovation? SoFi has it. Want to buy your first house? SoFi offers mortgages. Want to start investing in stocks, ETFs, or even crypto? SoFi Invest. Need a credit card? SoFi Credit Card. The ultimate goal is to have you live your entire financial life inside their app, dramatically increasing the lifetime value of each member. The single most important event in the company's modern history was its acquisition of a national bank charter in 2022. This was the moment that truly separated SoFi from the vast majority of other fintech apps like PayPal and Block. The charter is so important because it allows SoFi to hold its own customer deposits from those checking and savings accounts and use that massive low-cost pool of capital to fund its own loans. Before the charter, SoFi had to rely on expensive warehouse lines of credit and partnerships with other banks to fund its lending. The charter gives them a much more stable and cheaper source of funding, which directly translates to a higher net interest margin, NIM. But, as we've noted, this gift came with a price: heavy-duty regulation. SoFi is now regulated by the Office of the Comptroller of the Currency, OCC, and the Federal Reserve, just like a Bank of America or Wells Fargo. They have strict capital requirements and are under a constant microscope for compliance, risk management, and consumer protection. Operationally, the business is reported in 3 distinct segments. First, and most important for profit, is lending. This is the powerhouse, encompassing student loans, personal loans, and home loans. This segment generates revenue from the net interest income on the loans it holds on its books and from gain on sale revenue when it sells packages of loans to other investors. Second is the financial services segment. This is the high-growth member acquisition engine. It includes SoFi Money, checking and savings, SoFi Invest, the credit card, and other services. This segment has historically been a money loser, but it's viewed as a marketing cost. It's designed to bring people into the flywheel with the expectation that they would eventually graduate to a profitable lending product. The third segment is the technology platform. This is the hidden piece of the business that many investors overlook. SoFi owns a company called Galileo, which is a banking and payments infrastructure provider. Other fintechs and even non-financial companies pay SoFi, Galileo, to use its technology to power their own debit card programs, digital bank accounts, and payment processing. This is a B2B, business-to-business play that provides a separate, high-margin software-as-a-service revenue stream. That Galileo piece is a key differentiator. It's a picks and shovels play on the entire fintech industry. Looking forward, the entire investment thesis for SoFi balances on a knife's edge. The expectation